Well, hello. This is Lydia Tate, lydiaspeaks.com. I am coming back to you to continue our conversation on credit. I've shared so far, I have 2 YouTube videos out there on credit, but I felt like I needed to expound on one subject, which is the different things that affect our FICO score, what influences our FICO score, and how that's calculated, so that we know why FICO, why when I share with you what needs to be on your credit report, you understand why that's necessary. So we know that we have the minimum credit score of somewhere around 300 to the maximum being somewhere about 850-ish, as we spoke about before. But I wanted to kind of dive a little deeper into these components of what really affects your FICO score, so that when you go to a financial institution, you are prepared to you are prepared and you understand why your credit looks the way they are. So somebody asked me recently why I do what I do. I am very passionate about empowering individuals to become better decision makers and making people financially independent. I'm passionate about seeing especially women very financially independent, to be able to take care of themselves, and if they're a single parent, to be able to take care of their children and not leaving the guys out. I also want, from the bottom of my heart, to see men making great financial decisions for their families and for themselves, or if they're single, being so prepared so that when it's time to commit to a woman, that they can be the men that God created them to be. So with that said, I want to dive into this. Yeah. And another thing also, I have seen so much in this industry that I've been for 20 something years. And I've seen a lot of people, I just put it out there. I've seen a lot of Black people, and that is African Americans and, Black immigrants, or people from other parts of the country, struggle with their credit and struggle with getting finance at financial institutions, and it kind of makes my heart bleed a little bit, because a lot of times it's because we are not informed, or we don't know what to do, or we don't know how to prepare to go to a financial institution and talk about what we want to get, or even how to get it, even if we know what we want to get. We're not prepared with our credit, we're not prepared with our financial documentations. But I'm not going to dive into the documentations today. I'll talk strictly about credit and just add on to the conversations that I've shared with you so far. And I hope that this makes a difference for someone. And if you'd like to talk more personally about your financial situation, please reach out to me at coaching@lydiaspeaks.com. I'll have that information down here on this underneath this video, or you could email me. No, you could email me at coaching@lydiaspeaks.com, or you could reach me on my website at lydiaspeaks.com, and we can certainly work with you and help you get there. So again, I'm going to dive deep into this here, a continuation of what we discussed previously. So in the previous videos, I talked about what influences our credit scores, and I mentioned that the credit score ranges from somewhere between 300 to 850 ish. I say ish because the FICO scoring can change a little bit depending on the different variables that I talked about in my previous videos. So if you'd like to learn a little bit more about that, then subscribe to this video, click like on it, and just listen out to other videos that I'll be uploading here soon. But besides that, there are other recordings out there that I've had, so you feel free to visit the other videos on my YouTube channel and learn more. Okay, so let's kind of dive deep into this here. Why do we have to have good credit? We've talked about that several times, and a couple of other reasons for sure is being able to let our credit work for us. So that pretty much means that when you have a good credit score, you can get a credit card with reward points. You can actually make money with your credit score. you do not have to keep a balance per se on your credit cards. If you get those, there are a lot of companies out there that provide bonuses when you sign up for credit cards. You could travel out of the country on your reward points because you have prepared accordingly, and you can qualify for those high reward credit cards. A lot of times to get those, you've got to have pretty good credit score. So you can actually get some money coming back to you if you use those credit cards wisely and if you have a good credit score. So, by the time you use your reward points, you've already managed your finances so well where you can actually pay off your credit cards in full. I know people who literally use their credit cards just to pay their bills, and then they pay it back in full, and they gain a lot of reward points. But the most important one is really when you do sign up for some of those credit cards, then you get reward points up front. They can do quite a bit for you. So that's just one way that you can make your money work for you, make your credit card work for you, make your credit card make you money, or make your credit score make you money. So another way, or you can purchase things without out-of-pocket costs. Like you could go to buy a car, and when you buy a car, they wouldn't need a down payment. Or you can do a conventional loan on your house, and they do have some scoring system there that can work better for you if you have a better credit score, and you get a lower rate of cost on your mortgage or anything else that you're buying. That way, freeing money for you to do other things. So because if you have a higher credit score, then your rate is lower. If your score is less, then your rate is higher. So you may have two people who own the same vehicle. One is paying $100 or $150 more than the other. It's simply because the other person's credit score was not sufficient to give them the better score. You both got qualified, but one is paying a higher rate than the other. So you want to understand why the cost of money is expensive for you. If it's expensive, it's because you perhaps need to work on your credit a little bit more. So let me dive into the different components of this credit so that you can understand what I mean here by this. So there's several factors, and we've talked about this in the previous videos, but I want to break it down a little bit more. The first one, and the most important one here, is your payment history, which influences your FICO score by 35%, almost 40%. That's quite a high number. On-time payments. So if you have any debts out there, if you're working to rebuild your credit, or if you're working to improve your credit right now, or if you want to maintain a good credit score, then you want to make payments on time. And when I say payments on time, that pretty much means you have to at least make your minimum payment. So if you're in a tough financial situation right now, then make sure that you're making at least the minimum payments that are due on your credit cards. But I also say that if you're making at least the minimum payment on some, consider the snowball debt payments strategy that we used earlier, so that you have at least one of them that you accelerating payments on, so that you can be able to get yourself financially stable. But catch up. If you have payments that are past due, talk to your financial institutions, find out if they can work with you on some programs that they have to bring you current. Some of them they will perhaps give you a fixed payment and allow you to catch up, and then negotiate with them on fixing what's showing on your credit as past due. We talked about recently, yesterday, or the previous video, we talked about the goodwill, where you can negotiate with the bank and say, hey, I was having some difficult time, I want to catch up on my payments, or can you bring my credit current? And a lot of financial institutions will work with you and will get your credit to show current, but of course they're not obligated to do that. So you've got to really prepare with your verbiage and your communication and what you share with them to have them work with you. So 35% is influenced of your FICO score. Again, is influenced by your payment history, and this goes for all the credit bureaus that we spoke about recently: Experian, Equifax, and TransUnion. They all go by these components. So I want to give you an example here. So let's say, for instance, that you have one card, right? One card, you've had it for, say, let me use a number here. Let's say you've had a card for 60 months. Okay, you've had a card for 5 years, and you miss one payment. So with that said, the way that FICO will calculate that payment history is really an average. It's an average of your payment, your on-time payments versus the length of time that you've been making the payment. So if you've made 59 payments on time out of 60 payments, so what FICA does is take 59 over 60, that equals to 98.3 payment ratio. That's not at 100%, so it will affect your credit score, because then you're not reflecting 100% on your payment history. If that number is a little higher, let's say you have two cards and one of them is 60 months payment history, the other one you just got this year, for instance, then the average years, the average years there then becomes 2 years versus 1 year. Okay, so but let's say for instance here that you have a card, you've had it for 15 months and you miss one payment. So it would be 14 months of current payment divided by 15 months. That's 93.3%. So that's not good. That's considered bad. So because the length of time you've had it is short, and you have short payment history, 14 months of payment history reported on your credit report, so that doesn't help you. So it's good that you have at least two cards. Like for instance, if you have two cards and you've had them for the same length of time, and again I'm going to use a 5-year period, so you've had them for 60 months, but you only have one late payment on one of the cards. So that means one late payment, one card has 59 payments on time, the other has 60 months on time payments. So that's a total of 119 on time payments. And then you take 119 and you divide that by 60, which is the total months of payment history there. So with that, you get 99.1% of on-time payments. That's really good. That's awesome. That's great. That will reflect good on your credit. But so you want to, that's why they always advise that you want to get, you want to be able to, you want to get good payment history, and you want to have at least more than one card, and you want to have them for a little bit of a longer period, so that it can reflect positively on your credit. So again, just to summarize that, 35% payment history, you want to have more credit available for a longer period of time. When I say more credit available, I mean you want to have like 2 or 3 credit cards out there with the good payment history, so that it's with the longer payment history, so it can reflect positively on you. Okay, so sorry about that. I was getting a call. So again, let me summarize that just in case you missed it. Have more credit available for a longer period of time. So you want to have more credit cards out there if you can. I wouldn't necessarily encourage it if you don't absolutely need it, but it's if you're just working on improving your credit score and you're trying to get a higher score, let's say you're aiming at 700 or 800, then you want to have more available credit with longer payment history. Okay. Then you want to make sure that you're paying at least the minimum payment. And I want to be sure, I may be talking to a different audience today, which is okay. You want to make sure that you're paying at least the minimum payment, right? But again, if your goal is to get out of debt, then you need to consider some of the videos or the lessons that I've shared on my previous videos, the debt snowball method or debt consolidation, or all the other options that are out there, including, I haven't spoken about any bankruptcies yet. We can talk about that later, but I just make sure that you're prepared for what's ahead of you, depending on your goal. If you're trying to get perfect credit score, you're trying to build your credit, then this lesson would really is a good one for you. Then the next component is 30%. 30% of your utilization affects your FICO score. So how are you credit, right? So let's say you have 10,000 credit limit and you use $6,000 from the 10,000 credit limit. That shows that you have 60% utilization. It's 60% utilization is high. You want to keep your utilization at 30% or less. And previously I mentioned that I would even recommend a lower percentage than 30%, maybe at 25% or something like that. But 60% is high. So if you have, let's say you have 3 credit cards out there and they're all at zero balances, more power to you. That's great. That makes your credit look good. People say that it's good to keep a balance on your credit cards. Not necessarily. You don't have to keep balances on your credit card to get your score to look good, because what they're looking at is how much of it are you using, right? And so if you're using zero, then you naturally get 100% score on the 30% utilization there, and then you do get positive influence on your credit report there. So you want to make sure that you're paying off your balances if you can, to just never carry a balance if you can't. If you can't, keep it at 30% or less. Okay. And then you want to again make sure that you have a lot of credit. If you can get approved for many, just have a lot of credit out there, as long as you have the discipline to not misuse it. You have good behaviors, you get, I call it good financial manners, and you're not spending all the money that you have available on your credit. If you are, then it's a behavior problem that you need to check. We cannot blame that on COVID. So you want to be sure that you change your behavior, change your behavior so that you can make good decisions there. And then you also, like I said, you also want to have a low utilization. You want to have you don't want to keep a balance. So that is 30% of your score is affected. 30% of your credit score is affected by your utilization of your credit. And then we also talked, and another point that I want to make, you also want to try and get a credit limit increase whenever you can. So if you have $1,000 limit today and you were trying to get your credit score to be at a higher percentage, maybe every 6 months or 12 months, talk to your financial institution and see if they can increase it, because that will reflect positively on your utilization. A lot of times when these institutions are increasing, they don't do a hard credit inquiry, they do a soft credit inquiry, and I will talk to you about the hard credit inquiry a little bit later here shortly. They do a soft credit inquiry. It does not affect your credit per se, but then they increase your limit for you so that your credit utilization can appear low. So if you have $1,000 limit and they increase it to $2,000 and you had a balance of $500 before, then all of a sudden your credit score increases in the next 30 days, because of course, like I mentioned earlier, most credit reports update their credit every 30 to 45 days. So you will see a change and a jump in your credit. And I also and then the next one is the length of credit that you have on your credit bureau. So how long have you had your accounts? And that affects or influences 15% of your FICO score. So the longer you've had your credit out there, the better. So if you're new in this country and you're looking to build credit, then it's good to go ahead and get some credit cards or get some sort of loan out there to help you establish credit. So I know several financial institutions here that will do a secured card for you, and we talked about that earlier. That's a good option to build or rebuild your credit. So consider that. Consider getting a secured card that would help you build your credit. If you can get a second account, I'll tell you what I did when I first came to this country. I got two cards. I got a bank credit card with a very low limit. It was a secured credit card. And then I went to a furniture store because we needed some new furniture, and I signed up for a furniture account. And then I went to a Firestone and got a card there because I needed to get my car fixed. Yes, I hadn't been in this country even a year at the time, and I didn't have cash flow, needless to say. So I got 3 accounts to build my credit. And so when time came for me to purchase a vehicle, which was probably a year or 2 later, because I needed to get a new vehicle to get to work, I was able to get a vehicle with a very good rate. So you want to have as many credit lines out there as possible. And these things, of course, like we mentioned earlier, they stay on your credit for 7 years, good or bad. They will be there for 7 years. So the longer that you have your credit out there, the better. So, but if it's not showing out there, if you don't see that it's looking so positive, just be patient. Be patient, and make sure that that is showing. Okay. So it takes an average of 2 cards over a 4-year period to show a good influence on your credit report. So you want to kind of be prepared for that. Again, an average of 4 years. So and an average of 2 cards to have show some positive changes on the length of credit history. And that again is 15% of your credit report is affected by the length of time you've had your credit history, okay? Your credit accounts out there. And then the next one is, oh, and I'm going to say something here. I'm going to say three things. One, open your accounts early if you don't have any accounts out there so that you can start building your credit. Two, if you pay off any credit cards, don't close them out, because if you close them out, then that calculation that we used to really show the average of the length of time that they look at, it gets affected. Okay, so you want to be sure that you keep that. I think I need to give you this example. So if you open a card 4 years ago and open another today, your average history length would be reduced to 2 years because it's the average. So if you close one, then that reduces it interferes with that average calculation, and then it reflects negatively on your credit. So that's why most financial coaches advise you not to close your card if you decide to get a card, okay? And then the next one is your total credit lines. Diversify your total credit lines. So the diversifying what you have on your credit report influences 10% of your score. So you really want to be able to have that, the diversity in place, okay? So make sure you have more credit, make sure you have a higher limit, make sure that you have lower utilization, make sure that you have on-time payments, make sure that you can handle the debt before you get into it, and then, make sure that you understand how many lines you can have out there that can affect your score. So 21 lines of credit or more is good. It sounds like bad advice from a financial coach, but I'm just sharing with you what I've seen and what I know that can affect your credit so that you can have the higher credit score. So this may not necessarily be all relevant to rebuilding credit, but this is targeted to people who are really working hard to get a really, really high credit score, okay? So 21 lines of credit or accounts, as far as diversifying, makes sense. But again, with those points, just make sure that you have more higher credit limits so that your usage can be lower. You have more on-time payments, so really all of them. If you have 21 accounts out there, make sure that they're all on time. Sometimes having a lot of account open can also affect you negatively. So it just depends on what you're trying to do. If your goal is to increase your credit limit, then this would make sense. If your goal is to get to a bank to get financed, then we would have to kind of talk and understand what your financial goal is, because sometimes when you have a lot of credit cards out there, the banks will see you as having too much exposure and that you can actually spend all that money. And if you spend all that money, then you're not going to be able to pay them back their loan. So there are some variables to this. The information that I'm sharing with you is for you to make an intelligent decision based on your personal goals, based on what you're trying to achieve, which the only person that can affect that is you, because your financial goals, your personal, your family goals, your family financial goals, your individual goals. So again, I'm just sharing with you to help you make some intelligent decisions. And then the last one is hard inquiries. I mentioned that I'd dive into that a little bit. So hard inquiries affect or influence your credit score by 10%. Lenders actually look at these inquiries. When you come to a financial institution, we will look at how many inquiries you've had. And sometimes if you've had several inquiries, the bank considers you a risk, because then we're thinking, okay, something is going on with this individual and they're going helter-skelter, they're going everywhere looking for credit. And the question is, why? What are you doing? Why do you have all these hard inquiries? What are you trying to achieve? Are you in some sort of financial crunch and you want to just get a lot of credit cards out there, or you want to get loans everywhere? And if we provide the lending solutions to you, then how are you going to be able to pay us back? So those are the questions that your bank will be asking also when you have a lot of inquiries out there. Sometimes some of those inquiries are grouped into one. Like for instance, if you're shopping for a car and within 30 days, then you have a lot of inquiries within 30 days, then it can be grouped into one. So it does not reflect necessarily as a risk per se. According to FICO score, it would not affect your FICO scoring per se, but I can assure you that your bank will still ask questions if you walk into a bank and then that shows up and they want to know what you're really trying to do, and it may appear as if you're not making good financial decisions. And that is why I always say be prepared, know your credit score, know how to negotiate before you even go to a dealership to buy a car. I never buy a car through a dealership. I think the last time I did that was several years. My first vehicle in this country, I bought being financed through the dealership. Of course, had new credit. I was trying to really understand, and it was more so because the bank that I worked for at the time did not even approve me for a loan because I had new credit and I was a risk. So they could not approve me for a loan because I hadn't worked for them long. Two, I'd been in this country less than a year and a half, and three, my income wasn't just the greatest. Okay, so even though I had established credit and I had some sort of decent credit score, but I still, according to the bank, I was considered a high risk. But then the funny thing is, I went to the dealership, and the dealership worked with my bank, which I didn't know they were working with my bank at the time, and I got approved for a loan through the dealership with the bank that could not approve me for this loan. And I think more so because they probably work and sell and get a lot of loans financed through this. They get a lot of loans financed, and they do a bulk transaction. So it's not just like this one person who's a risk, and the dealership probably has some sort of agreement with them. If there's a repossession, maybe there's some sort of private agreement that I am not familiar with or aware of. So you just never know. So, I'm just, again, like I said, a lot of the things that I'm sharing with you, I have learned along the way. I've learned a lot of things along the way. Like I said, I've made some mistakes along the way, and I've learned from them. And another thing also, some things that I wish I knew now make a lot more sense because I spent a lot of time in the industry, and also I have studied for myself, and of course, some things I learned in college, but in college they don't necessarily teach you as much as what I have learned just from personal experience working with individuals and working with even businesses, which is a deep passion for me. And we will get into that another time. But now, another thing that I also wanted to leave with you is, more of an action plan that I hope that you can follow. Just to summarize what we've spoken about. So the action plan then for you, if you're trying to get a higher credit score, and maybe you don't have bad credit, right? Or maybe you have bad credit. I don't know. Whatever your goal is fine. So the first action plan then is to check your credit score. And how do you do that? You go to Credit Karma. You can go to Credit Sesame. That's also a good one. You can go directly to Equifax or Experian or TransUnion. That's also a good one. And you can either call them or reach out to them online and get a copy of your credit. And then once you get that, sit down just like you sit down with your bank statements. I hope you do. And write down all your bad debt, write down all your good debt, and start strategizing on how to pay the different debts off, and also strategizing on how to bring everything current. And when you strategizing on how to bring everything current, consider some of the options, the action items we worked about, like negotiating with your bank to settle your debt, maybe talking to the bank about a goodwill, or once you pay off something and that they're able to take it off your credit or bring it current. Consider disputing errors on your credit. Consider look at the length of time you've had your credit history, and then you know what's affecting your credit score. If you haven't had it for a long time, or if you have a lot of hard inquiries, which you can dispute the hard inquiries, they only stay on your credit for 2 years anyway. But they affect your credit for 2 years anyway. So you want to be sure that anything that is less than 2 years old is legit. If it's not, then you want to dispute that. It makes a big difference, actually. Every little change makes a difference. So, and then you also want to be sure that your utilization is correct. If you see that some of your balances are not reported correctly, then make sure you get with the bank and find out. You want to look at your bank statements on your credit cards and find out when the statement is actually cut off. That way you can try and beat that time. Like, you make sure your balances are low, even if you have to take from one account and pay it down. And then, this is bad advice, but it's good advice at the same time if you're trying to improve your score. Pay down right for the time before they report your information to the credit bureau, so that your account can show current. okay, or show with a lower utilization percentage. I mean, I would challenge you, ask your bank, when do you report this account to the credit bureau, and just try and manage your finances in a way that your balances will always be at a lower amount when they're reporting this to the credit bureau. Okay, so the goal here, again, you're trying to work to improve your credit score. You're trying to get a higher credit score. It requires some work, and it requires some strategy here. So again, that's the utilization part. On the payment history, make sure you're making at least the minimum payment. If you have credit cards out there or other loans that are opened, even when you're trying to rebuild your debt, just make sure that you pay at least the minimum payment. If you're subscribing to a snowball debt payoff strategy, that's fine too. Just make sure that all your other accounts are paid on time with the minimum payment as you focus on the one that you're targeting to pay off. And so that at least the 35% can look good, because any negative credit, any negative history stays on your credit for 7 years. But again, if you can work with your bank to see if you could dispute some of those to bring your account current, that would be good. The one that affects your credit score the most are those revolving accounts, like I mentioned before, like the credit card. So if I can give you a practical example, if you pay off a car loan, right, your score may go up by maybe affected, or pay off an account, an installment loan, maybe 10%, even if so. If you reduce your credit card's utilization by 30% to 25%, your credit score can go up almost 100 points, depending on how many accounts you have out there and what the limits are and things like that. So you have to understand that those credit cards really, really, really affect your credit score. The utilization affects your credit score. The payments on time or payment history affects your credit score. Hard inquiries affect your credit score. Length of time affects your credit score. So you want to just pay attention to all these factors if you're looking to improve your credit score, and also looking to get that high number of 700 plus. Now, I tell you, if you have an 850 or a 760, the interest rate that the bank would charge you would pretty much still be about the same, because that's considered excellent credit anyway, between 760 and 800, 850 or whatever. So if you're aiming to get a really, really excellent credit score, if you get to a 760, that's a good number. You know, if you're optimistic and you want to try even harder for an 800 score, go for it. But start with the little steps, and you'll see that those little steps make a difference at the end of 30 days or 45 days or 60 days. But you've got to start. I'll leave you with an advice that my father gave me many years ago, and I still use this in my life today. He always says, Lydia, if you want to do something, you've got to start. Whether you have the resources to do it, whether you have the skills to do it, whether you have people to support you to do it, you've got to start doing it. Because as you start doing it, then God provides resources, God provides the right people to help you along the way, God provides the support that you need to do the right thing. So if your goal is to improve your credit, if your goal is to improve your score, if your goal is to make better financial decisions and to be financially healthy, then you probably want to start today. And if you want to journey with me with this, you can reach out to me at coaching@lydiaspeaks.com, or you can go to my website, lydiaspeaks.com as well, and reach out to me, and I will be glad to give you some counsel based on your own individual financial goal and your own individual financial situation. Again, I want to say thank you. And I also want to take you back to the scripture that know that all things are possible, right? That God has a good plan for you, that you have not seen anything yet, that God's plans are much bigger and much better than where you are. And you better believe that He has a good plan for you. And no matter what situation you're going through, no matter what your financial condition is right now, no matter what is keeping you awake at night, that He has a good plan and He loves you. And I hope that you have a wonderful, wonderful day. Thank you.